Greetings, class. I wanted to go through this one exam practice question that we had talked about in class, just to do a video to make sure you understand the overstated, understated. I'm going to go into more depth in this example than you'll need for the exam, but we'll look at a quick and easy way that you can solve these in the exam while you're sitting down. So the question is, what will be the result if no adjusting entry is made at the end of the accounting period to record the actual use of supplies? We're trying to figure out if one of these major categories of liabilities or assets will be overstated or understated. So the question is regarding supplies. So supplies are an asset to begin with. So we have our unadjusted trial balance from the Eagle Golf Academy, which is the example we've used throughout our time together so far for the first 3 chapters, and the supplies account has a balance of $2,300. If I use this unadjusted trial balance to prepare a balance sheet, which you will not need to do the exam, but just to show you, so supplies of $2,300 gives us total assets of $41,000. Liabilities with the same balance sheets is $12,009, and stockholders' equity is $28,001. So the question says, what will be the result if no adjusting entry is made at the end of the accounting period? So we know based on Chapter 3 for the Golf Academy that there was an ending balance in supplies of $1,100, which, using our formula that we learned in Chapter 3, we take the beginning balance of supplies less the ending balance to get our supplies expense. So if we go to the general ledger T accounts, we had a beginning balance of $2,300. We're deducting the $1,200, which is our expense. This is our adjusting entry that we're making in order to recognize, based on the matching principle, the supplies expense for this accounting period. So the $1,200 is a reduction to supplies and an increase to the supplies expense account. So at the end of the adjusting entry, once the adjusting entry is made, your supplies will be at $1,100 versus $2,300. So currently, right now, they're shown at $2,300, and so what the question says is, what will be the result if no adjusting entry is made? And that's what we have to look at. So right now, looking at the adjusting entry that should have been made, supplies is an asset, and supplies expense is under stockholders' equity. And let's look at the accounting equation. So expenses fall here, just so we follow this. Expenses fall here, which tracks up to retained earnings, which tracks back to stockholders' equity. So when I say expenses are under stockholders' equity, that's how that tracks. So just make sure you have a conceptual understanding of that. So then what happens if this adjusting entry is not made? We have a balance of total assets. So we're looking at assets and liabilities. We see, first of all, that neither account that is in the adjusting entry for the supplies account is a liability. So we know A and D cannot be correct. So then we come down here and we say the assets before the adjusting entry are $41,000. If we're taking away, which is a credit to the asset account, $1,200 from this $41,000. So the assets after the adjusting entry, which would be correct, so $41,000 minus the $12,000 that we're reducing assets by, should give us assets of $39,008. So if we say we didn't make this adjusting entry, we would still be showing the $41,000 versus the correct $39,008. So we would have to say the correct answer is B, assets would be overstated, because we'd still be showing them at $41,000 versus the correct answer, which would have been $39,800 after we do the reduction. So I hope this is a good summation of a very conceptual aspect of what we've learned. This is an attempt to kind of sum everything together to see what your understanding is. On the exam, I think there's only 1 or 2 of these questions. So hopefully this is helpful. Thanks.